Yo, what's going on, guys? Welcome back to another video on the channel. In today's video, we're going to talk about two things that you need to have in a stock market environment like we are seeing right now. You guys know, if you've been watching the market, we have a lot of high growth tech stocks and even some Dow stocks falling off their highs and presenting some opportunities. The big question on everyone's mind is, when will this dip slow down and when will those opportunities start to present themselves for us to start buying these stocks and looking for that bounce higher? If you have these two key things in your long-term portfolio and in your trading plan, you will be sure to survive this dip and be able to take advantage of any bounce higher. So with that said, let's go ahead and jump into this video. Press that like button for me and subscribe to the channel. I am live streaming now from 8 to 8:30 a.m. Eastern time every single market day. So if you want to stop by for that, subscribe to the channel and press that bell notification so you're alerted every single time that I post. So guys, the number one thing that you need to have in your long-term portfolio right now is cold hard cash. You need to make sure that you have that buying power available for when these dips start slowing down so that you can take advantage of these moves back to the upside. You guys may have noticed a lot of tech stocks sold off post earnings, and this is largely due, even though they had great earnings, this is largely due to fund managers selling some of their positions, trimming some of their profits, and making sure they have liquidity because maybe they are seeing some slowdown in the market. They were spot on. There was inflation fears coming out, the market is selling off, and selling into those earnings was the best opportunity, and they really nailed it on the head. Some of these fund managers that sold Amazon, Apple, Square, PayPal at their highs right when earnings were coming out, making available some of their cash. When they see that market start to dip and there start to be better deals on these stocks, you know that they are going to have that cash ready to buy up those dips and to ride these stocks back higher. Now, of course, there are three different ways that you can make sure that you always have cash in your long-term portfolio. The first one is just never to fully invest. Maybe you have 20 to 35% cash available at all times. You invest the other 70 to 80% in stocks or in options. The second way is to make sure that you have some money in your bank account that you're willing to invest, that you can transfer over to your brokerage account and be able to invest that way. The third way, which I've been doing personally for some time now over the last few weeks as we've seen this market start to slip, is to start trimming some of your best performing stocks. Now, for me personally, I've been starting to trim some of my long-term positions that are up over 20 to 25%. So Penn National was one that I caught very early. DraftKings was one. Home Depot was another. We had Square that was extremely high, and another one was Snapchat. All of these stocks were up over 20 to 30% in my long-term portfolio, some of them even higher, and I've been starting to trim some of those positions to make some cash available in my long-term so that when I see these juicy dips start to show themselves on some great stocks like Square, Tesla, PayPal, Apple, Microsoft, when I start to see these dips coming, which they are right now, I have that cash available ready to purchase these dips. So for me personally, I've been trimming some of my outstanding winners to make sure that I have that cash available. Now, this is exactly what some of these fund managers have been doing. They were selling some of their great performing tech stocks into those earnings reports, making sure that liquidity is available. So overall, guys, having that cash available, whether it's you putting money into your account, whether it's you never investing fully into stocks and always having a cash reserve, or whether it's you starting to trim some of those really outperforming stocks to make sure that cash is there. Don't be someone that is left on the sideline not purchasing any of these dips because you don't have any cash available. You're just holding your stocks. Of course, at the end of the day, if you really look at the long-term picture, most of these stocks will be back. So if you just want to hold out and you don't really feel like buying dips, then of course that is not a bad strategy as well. But if you have cash available, which I always recommend to have some cash available, you can look to buy some of these dips at the time that looks right. So the next question that is most likely on your mind if you are a long-term investor or you're looking to buy some of these dips is, when is the right time? And of course, trying to time the bottom is never a strategy that's going to work out, and buying all of a single stock at one single time with the cash that you have is not a recommended strategy. what I would say is to start dollar cost averaging. If you have $10,000, spend $2,000 per week, maybe spend $500 per week, so that you can span out those purchases over time, so that you can continue to lower your average cost of these stocks, whether you're up on the position or whether even if you're down in the position and you want to lower your cost basis. So making sure to dollar cost average, not throwing $10,000 into the market at one single time, because then you are locked in that time, and you're locked in at that price on the stock. So if you have 10,000, something that I hear from Kramer quite a lot, make sure to dollar cost average. You want to be in the market at multiple different time frames so that you can continue to average down. So that's my recommendation. That's number one. Make sure you have that cash. Make sure you start to buy some of these dips over a longer time period. Don't just buy all at one time. And having that cash is going to be king when these stocks start to rebound and start to move higher. So guys, the second thing that you must have in this market right now is risk management. The market has been quite choppy, up, down, overall mostly down for the last few weeks, but it has been choppy and it has not been consistent. Making sure that you have that risk management, that you can survive this dip, is crucial. You do not want to be wiped out on a 4 to 5 to 6% dip on the market because you over leverage yourself and you use too much in some positions. I'm not going to lie to you. Me personally, I have taken some losses in the last few weeks. I'm down on Snapchat. I lost on a Boeing trade. I've lost on a Facebook trade. These losses that I did take. But what about these losses is keeping me in the game is that I'm risking an extremely small percent of my portfolio, and no matter what happens, I am going to be around in the market, being exposed in the market for when the market starts coming back. So if I take a 1%, 2%, 3% loss on a trade, I am still going to be here, and I'm still going to look for opportunities in the future, and when the market starts heating back up, I'll be sure to take advantage of those times and those moves. Patience and risk management is so crucial investing in the market and even trading in the market, because you have to realize that there are always going to be better opportunities in the future. Trying to make money right now in a market that is sliding lower, if you're not bearish and you're not trading puts and you're not short selling stocks, is very difficult. So trying to buy some of these dips, hoping that you're going to make a ton of money in the next few weeks to next few months, is sort of unrealistic unless the market does something crazy and spikes up back to all-time highs. Patience, risk management is so crucial. My positions have been very far and few between. I have not been taking many trades. I'm just waiting, patiently waiting, stacking up that cash position in my long term, getting ready to use that cash when I start to see the market come back higher. Right now, I don't think it's a great time. Inflation's fear is still here. Market is definitely sliding lower, but I'm going to continue to dollar cost average with the cash that I'm receiving, and I'm going to continue to look for opportunities. So that is the second thing, risk management, making sure that you do not get wiped out in a dip like we are seeing right now. So guys, I just wanted to make this video today for someone out there that is sort of worried about the market, what's happening right now. How do I manage my long-term portfolio that is down, say, 5 to 10% in the last few weeks? Well, what you should be doing is to make sure that your positions are correctly managed with risk management, and also that you have that cash available. When these dips start to look like they're good opportunities, you can start to dollar cost average, and with risk management, you will know that you will still be in the game. So guys, I hope you enjoyed this one. Just a quick reminder on making sure you have that cash, making sure you focus on risk management during this difficult time in the market. If you enjoyed this one, press that like button for me, subscribe to the channel, come hang out every single morning from 8 to 8:30 a.m. Eastern time in the live chat. I would love to see you there. I hope you guys have a great rest of your trading week, and I hope to see you in the next video. Peace.